welcome to the Monday Futures Market Outlook for January 28th, 2013. It's Patrick Ceresna. For those of you that have not had the opportunity to try out our eMiniSource.com trading room, complimentary memberships are available on the website. The currencies, commodities, stocks, and bonds that we discuss throughout this video, we go through in extensive detail and analyzing in our Market Timing Strategist newsletter. Visit the website to learn more about it. As always, we start off with a chart of the U.S. dollar index futures. The U.S. dollar has been stuck in a substantial range in the last 6 months between the 79 to 82 level. Really, at this stage, there's a lack of conviction for the dollar to make a move, and really at this stage, we don't see any reason why that would change on the short term. While there is vulnerability of the U.S. dollar to work its way down toward the 79 level to test the supports along the bottom, we also are not don't feel it's a very strong probability that there will be a very big drop by any means, other than maybe a short-term move of $1 or more. Really, at this stage, one of the reasons is because of our forecast on the euro. The euro would have to have a very substantial rally in order for the dollar to have a very substantial drop, because it's one of the major input variables in the dollar index. And because we don't see that, then anticipating that the dollar index will find support and then bounce is likely the most likely course of action. Next year, when we talk about that euro, this is the chart where I was referencing. We, in fact, believe that it's very probable that the euro will find overhead resistance up along the 2012 highs, up in this 135 area where we're literally testing it as we speak. And while this does not make it imminent that the euro will drop, we also don't believe that there is a lot of upside potential in being in the euro. In fact, there's an intermediate swing high could very well come in the euro somewhere in the next 100 pips over the next couple weeks. Really, at this stage, if you've been long the euro, this is a prudent time to be profit taking and repositioning your currency stance. Next year, I want to take a look at the 30-year Treasury bonds. At this juncture, the bonds have been consolidating down toward a major support line in this 143 area. While bonds have been deteriorating quite a bit, we still do believe that there is room for these bonds to still rally yet one more time at some juncture. In fact, it will be a very good indication of when the stock market will be prepared for a bigger picture correction. We're going to be watching how bonds stabilize at these levels. We don't believe that means that today or tomorrow we're going to see the bottom, but we could see bottoms come off of these levels in the next couple of weeks. When we finally do see a reversal in Treasury bonds, we're going to use that as a signal to completely reposition ourselves on our position on the stock market. Next year, I want to take a look at copper. Copper, like the U.S. dollar, has been stuck in a very tight range over the last 6 months. It's been sort of bouncing up and down and really been consolidating and coiling into this one area around the 365. At this stage, we do not believe with any very strong conviction that the copper will be able to make a material move higher or lower, but there is definitely room for even 20 plus cents moving higher or lower on short-term thrusts. At this stage, it's hard to have a strong bias one direction or another until we have some sort of a short-term break that will give us clues as to where momentum is building. Next year, I want to take a look at crude oil. And crude oil is at a crucial juncture. While we do believe there is room for crude to work its way up to 100, 102 on the upside, at least up till now, we have found some overhead resistance at this 96 level. If we see crude oil find short-term highs at these levels, this is a place where crude oil can reverse and even begin correcting on the downside to a retracement back to $90, $92. And so while we're going to be cautiously optimistic, we're also going to be very much paying attention to whether this is a reversal point or not. Next year, I want to take a look at gold futures. And we have seen gold consolidate back down to the 1650 level. This is a crucial make it or break it moment for gold right here, because if this is just a bottoming formation along 1650, then this is a compelling buying opportunity here. But at the same time, traders and investors must be prepared that if there is a substantial breakdown of the support, then we may have to first see a testing of the lows that were put in between April and the summer, July, August lows. Before the meaningful bottoms come in. So really at this stage we're watching here. This could be a major turning point level, and it would be a short-term letdown if there was a further deterioration below this focal point we've drawn in. Next year, when we take a look at the S&P 500, we are now approaching what I put in the blue box, our key overhead targets. While we do not necessarily believe that that makes it imminent that a market correction is beginning today or tomorrow, we do believe at this moment that the risk-reward proposition of investors remaining in the market is poor, which basically means the potential profit you have to make for staying in is completely outweighed by the risk you have of actually staying in. And so really at this point, we do believe that this is a place for active profit taking and repositioning. It may be a little bit early or ambitious to be shorting the market, but certainly reducing and profit taking your positions is a very prudent exercise here. Just to review our key intermarket observations, our short-term outlook on the U.S. dollar remains relatively neutral. Commodities, we're optimistic, particularly on gold and some of the other ones. While copper and oil are sort of at a major decision point, we don't see a reason to immediately have to change that short-term outlook. On bonds, we're going to change that outlook from poor to average, if not good, in the next week or two, depending on how the bonds behave at these levels. At some point here, actually, bonds may be a good short-term opportunity, and we're going to be watching how that support level holds. In terms of stocks and global stocks, 100%. We are now very firmly in this poor outlook. While the trends are up, and it doesn't mean a reversal is imminent, we do not believe that there is a benefit for our members and our listeners to remain in the markets, as the upside benefit is no longer as attractive as it was when we were very interested in owning it many months ago. Nonetheless, that's our stance, and we'll keep updating you guys each week on how this continues to develop. That was your Monday Futures Market Outlook. Thank you for joining me.